All right, welcome to Talk Tickers. Today, we're going to break down Tryg's third quarter earnings report. And believe me, it left the market with one big question.
I mean, the headline numbers, they looked pretty good, right? But then, by the end of the day, the stock actually closed down.
So that's the big mystery, isn't it? How does a solid earnings beat end up not impressing anyone? Let's get into it.
Okay, first things first, let's look at the scorecard. How did Tryg's results actually stack up against what the analysts were predicting?
And right away, you can see it's kind of a split decision. I mean, Tryg totally delivered on the bottom line. They beat expectations on key profit numbers like EPS and pre-tax profit. But, and this is a big but, take a look at the top line. A slight miss on insurance revenue. Yeah, and this slide really paints the picture of the whole quarter, doesn't it? On the one hand, you've got this rock-solid core profitability. I mean, their combined ratio was great, solvency is up, that's the good. But then on the other side, you've got that weaker revenue and a pretty big drop in their investment income. It's a classic tug-of-war.
So let's keep going, because the real bright spot in this whole report, the part management was really happy about, was the core insurance business itself. Now, to really get how well they're operating, you got to understand one key number, the combined ratio. It's pretty simple, actually. For every dollar they bring in from premiums, this tells you how much they're paying out in claims and expenses. So anything under 100% means they're making a profit on their underwriting. And the lower that number, the better.
And, well, Tryg absolutely delivered here. They posted a really strong 78.6%, beating the 79.2% that everyone was expecting. And listen, this was no accident. This was all about disciplined execution, plain and simple.
So what was driving this? Well, it was the result of all these profitability initiatives they've been working on. They saw great progress, especially in their Norwegian private business. And check this out. Their commercial segment was on fire, posting a combined ratio of just 73.7%. That is excellent.
Okay, but it wasn't just about the numbers this quarter. On the earnings call, management spent a ton of time talking about a big strategic shift they're making, all focused on efficiency. And the centerpiece of this whole plan, it's a massive 7-year, €550 million deal with Tata Consultancy Services, or TCS. They're basically bringing them in to completely overhaul their entire IT infrastructure. So what's the goal here? Well, it's all about radical simplification. They want to consolidate their IT suppliers, standardize how they develop things. Get this, from 10 different methods down to just one. And they're planning to cut their IT headcount by about a third. The whole idea is to free up a bunch of resources so they can really focus on hitting their big strategic goals for 2027. And this whole move ties directly into management's core philosophy. The CEO, Johan Brammer, he made it crystal clear on the call. He said something like, look, anyone can achieve growth, but profitable growth, that's a different story, and that's the only thing we're interested in. So the message couldn't be clearer, right? They are not just chasing growth for the sake of it. So that brings us right back to where we started. If the core business is running so well and management is this disciplined, why on earth did the stock fall?
Well, it's because the market pretty much ignored that awesome underwriting result, and instead it zeroed in on the headwinds. What are we talking about? We're talking about investment income just falling off a cliff from 526 million Danish kroner last year all the way down to 177 million. Then you've got that nagging revenue miss and a growth story that's, well, disciplined, but it just didn't have the excitement investors were looking for. So here's the bottom line. This was a classic case of a really high-quality operational result just getting lost in the noise. The whole story got hijacked by those weaker investment returns and a growth outlook that was, more slow and steady than fast and furious.
All right, so where does all this leave us? What's the final verdict here on Tryg? And maybe more importantly, what's the trade going forward? Okay, after weighing everything, the really strong operational performance on one side and that kind of muted growth outlook on the other, we're ready to put out our view on Tryg. And we are rating the stock market perform. Look, let's be clear. This company is a best-in-class operator. They've got rock-solid solvency, and they are seriously committed to returning capital to shareholders. But that super disciplined growth strategy, combined with those headwinds on the investment income side, we think that's probably going to keep the stock performing right in line with the market for a while instead of breaking out and outperforming. Okay, so now it's time for our favorite, this is totally not financial advice segment. Here's how we're thinking about the opportunity. We actually see a pretty interesting paired trade here. The idea is to go long on Tryg, betting on its proven profitability and its commitment to shareholder returns, and at the same time short a basket of some of those high-growth, cash-burning Nordic insurtech companies.
What is this trade really about? It's a classic flight to quality bet. The whole idea is that in this kind of market, investors are going to favor the disciplined, profitable companies like Tryg, the ones that actually give money back to shareholders, over the more speculative, growth-at-all-cost stories.
So that's our take on Tryg Q3. It really is a story of quality over hype. And as always, this is not financial advice.